A very good afternoon and a warm welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Kukule Tukele in for Tumisho Greater today. Well, on the show this afternoon, we take a look at what's in store for the South African economy and discuss the outlook for Rand Merchant Insurance. We also look at the questions that you need to ask before you purchase your home, and we're also joined by a panel of experts to discuss the investment opportunities that are currently taking place in South Africa's automotive sector. We also want to hear from you, so as usual, you can send your comments or feedback to moneymatters@abn360.com. But let's get into the show now as we take a look at our trend of the week. It's the morning after the night before, where the decision by Standard & Poor's downgrade to Brazil's credit to junk status earlier this month has raised the question on whether South Africa could potentially be next. One Fitch director said that the risk of downgrading for South Africa to junk is increasing, with American private banking group BBH also saying that it won't be surprised if the country slips into junk territory. In studio now to discuss the outlook for the local economy is Colen Garrow. He's an economist at Lefika Securities. Good to have you with us today, Colen. Firstly, let's take a look at the Fed decision with regard to the interest rates decision to keep them unchanged. Was this a correct move by the Fed in your view?
I think in terms of what they're looking at, trying to bump inflation over 2%, that's the one focus they've got. The other one, of course, is wage inflation, which has got to come from the stronger labour market. So those two issues, I think, in context, delayed the decision possibly to December. But I think the markets are maybe breathing a sigh of relief that she didn't put rates up last night. Of course, our Reserve Bank meets next week, so I think certainly takes some pressure off our MPC to do the same.
Why not, though? What about our own inflation figures and the targets there for our MPC, maybe just to boost it by another 25 basis points? The rand's come back quite nicely, and I think the Reserve Bank is responding more to the pipeline pressures that are probably coming in still to the weaker rand. They're coming in, maybe on a delayed basis. But I think for now, the decision to maybe sit, just sit on your hands and do nothing is very opportune. I also don't think it's to do with inflation. It's maybe to do more with the rand exchange rate. It's more to do also with preserving the economic growth that we've got. We've had one quarter of contraction. It doesn't look good. We need another consecutive quarter of contraction and then officially we're in recession. So I think the Reserve Bank would be sensitive to not be seen to bump rates up and facilitate an economic condition that markets are speculating we're going to be veering towards more and more. We wouldn't want our SARB to be responsible for South Africa's economic contraction, clearly.
Certainly not.
Exactly, which obviously leads us to comparisons when it comes to our emerging market peers. Countries like the likes of Brazil going through its own significant recession, and not only that, but also cap in hand now, looking to go raise some kind of capital also going forward. But if we take a look at the similarities between Brazil and South Africa, are there any that could see South Africa following the route of Brazil?
I think the outcome, as I said, is probably a downgrade in our credit rating. I think that's probably the route that South Africa is going. I say that with hopefully not, a huge amount of confidence on this thing, but most banks and credit rating agencies have got a value at risk model, and it's weighted in favor of Brazil, more so than other emerging markets. So what happens when you have a downgrade in one market, it prompts downgrades in other markets as well. So this is where South Africa comes in. And you can just see what the market was thinking maybe this time last week. There was an article carried by the Wall Street Journal, and the credit default swaps were pricing the possibility, a high possibility of debt defaults by Brazil and South Africa and Turkey. So this is where we're fitting in. We're fitting in together with Turkey, countries like, I think Kazakhstan's another one, Colombia's another one. So it's unlikely, I think, that S&P would have done the downgrade of Brazil in isolation. It would have had a look at all the other emerging markets in the same risk bracket and said, okay, South Africa is maybe a candidate as well to to anticipate a downgrade in the credit.
On that though, Moody's has kept South Africa's rating fairly stable. S&P still scheduled to come out, but is there anything that our Finance Minister Nhlanhla Nene can allude to in his medium-term budget speech that could allay fears from the ratings agencies?
It's a difficult one. He's got a very, he's got a very tough mini budget to get through. There's very little really that he can do, I think, to allay the market fears. But what he can maybe do is just underline the commitment to counter-cyclical spend on infrastructure. We've got this huge infrastructure spending program that we haven't heard really too much of over the past few years, but it's still there. The mechanics are there. We know the money's been put aside on, 3-year medium-term budget estimates. So we don't have to really recreate the wheel. We just have to freshen things up again and try and get the spend on infrastructure going again, get people working, get the economy going again. So certainly that's one issue of maybe addressing economic growth. But of course the question is, are we going to be able to generate the type of economic growth that we need? Yeah. Not just for South Africa, but I think in terms of allaying the concerns that the major credit rating agencies have. Because in your whole basket of economic indicators, you've got your fiscal deficit, you've got your public debt, interest and servicing debt, your public sector borrowing requirement. They're all referenced against GDP. So if you're going to be revising your GDP estimates lower, you're putting those ratios at risk, and you're also putting at risk the current sovereign rating that we've got from S&P in particular.
What about our public sector wage bill? Should we see potential slashes there?
I think we will. It's no comfort that I see at times the contingency reserve account being dipped into. It's our insurance fund really for the economy to protect us against floods, force majors, etc. But that's been dipped into to meet the requirements we have on the public sector wage bill. So it's going to be an ever bigger pressure on the fiscus. And my best guess is that we're going to have to approach the overseas lending markets. We'll have to go offshore to borrow money. We'll have to go back into our debt market to borrow more funds. It's a structure that needs to be upheld, but it's going to be a costly one for the economy and for the taxpayer.
Colen, let's certainly hope there's light at the end of the tunnel. I was going to be daring and ask you about potential tax changes as well that we might have to look out for, but I don't want to put you on the spot. Okay. Thanks so much to Colen Garrow. He's an economist at Lefika Securities. Time now for us to take a quick look at our Finweek Punt of the Week.